Hi, I'm Aaron Huebner. I'm with the Ascent Network, and I'm here today at the Orange County Real Estate Focus Group. I've been asked to address the group today with regards to how to help people improve their credit scores and remove negative items from their credit profiles. The realtors that I'm going to be addressing today, and the subject of my talk is turning your dead leads into real deals. I hope you enjoy the presentation, and I hope you find it beneficial. Thank you very much. Credibility in the business that I'm in is absolutely critical to being successful. And I've chosen by nature to be in an industry and to serve a group of people and clientele that normally draws a lot of individuals that are less than ethical. And it's very, very important to me to establish to groups such as yourself the fact that I've been around since 1977. I've never had any complaints with any federal or state agency leveled against me or any company. And we've helped literally hundreds of thousands of people in my working lifetime with the companies that I've started and have been affiliated with. So with that being said, the Ascent Network started, as Mike said, actually the idea started in 2005. We actually became a nonprofit and filed for nonprofit status in 2009 due to regulatory reasons, both here in the state of California and federal-wise. It was necessary for us to establish that. Today, my goal is very, very simple, and that is for you all to leave this room today with one single idea that over the next 12 months will bring you one additional sale. That's my goal. One idea over 12 months for one sale. And if I do that, I'm putting money in your pocket. We're going to be talking about today helping your clients get the credit they deserve, and on the flyer that a lot of you probably saw, I titled kind of this talk, Turning Dead Leads into Real Deals. So often, you as salespeople are called out and sit down with people who have these dreams and desires that they want. But the reality of today's economy is they're just, without help, they're just not going to get it. They're just not going to attain it. They've been given false information. They've hit a hard spot somewhere along the road financially, and they're years away. But yet, you've got the job of somehow walking that tightrope of not discouraging them, but bringing them to the reality that now's maybe not the right time. Well, hopefully after you leave today, some of those clients, maybe just one of those clients, you'll be able to turn around and actually be able to work with. We're going to be talking about a program and a service that we utilize, or that I've named CSIS, Credit Score Improvement Services. What we do is we focus on two things. One, driving credit scores up, and two, removing items from the credit, from people's credit profiles that are having a negative impact on their items that should not be. I'm thinking of a number between 350 and 850. A couple of years ago, that number was 450 to 805. Why did it change? It changed to broaden the gap. Why did it need to broaden the gap? Because the credit bureaus became tougher on their credit scoring. It dropped everybody's credit scores. As a result, they didn't want to take the heat. They didn't want to take the heat for that. So what's the easiest way to do it? You change the rules. So they broadened the scores, and they could say, well, the same amount of people, percentage-wise, is still in that good credit range. However, the guidelines from the banks didn't change. So the lending has, as a lot of you have experienced, the lending became a lot more difficult. A lot more difficult. Credit scores are created on the fly. And by that I mean this. It's a snapshot in time, instantaneous. Where a person sits today, where a person sits literally this hour. Because depending on what that client does, I have seen clients that have started the day, literally a day on the calendar, have started the day, and they're automobile shopping. And by the end of the day, the last dealership they've gone to, their credit score has dropped in excess of 20 points. Now you might say, how can that be? Well, inquiries play an impact. And you might say, okay, how many dealerships can a person go to in a day? 3, 4 dealerships? 3, 4 inquiries? No. No, it doesn't work that way at all. You go to a car dealership, that guy that draws the boxes, and when he walks away and takes it to the back room and hands it to his finance and insurance guy, that guy has a program that he runs that can draw up to as many inquiries as need be for finance companies that they are affiliated with. And it's not for the client's best interest who he puts the deal with, it's for his best interest who he puts the deal with. Because just like it used to be in the mortgage business, they sell the loan to the company that's going to pay them the highest premium. Well, in order to find that, they have to run multiple inquiries. So one application in a car dealership can lead to 7 to 15 inquiries. That's going to have a major negative impact on that client's credit score, especially if they go to a number of different dealerships. What makes up a person's credit history is very, very, very important. You can see, correct? The parts that make up a person's credit history, payment history is the biggest percentage, about 30%, or 35%. The total amount owed is about 30%, length of credit history, 15%, new credit and types of credit used. It's very, very interesting in that the type of credit that you use, while it only takes up about 10% or combines to about 10%, people have between 6 and 7 different types of credit on their credit profile. And that can actually also work against that individual. There's basically 3 types of credit that a person should focus on: real estate mortgage, an installment loan, and when I say loan, I'm talking a singular loan, and a revolving charge account, and that could be no more than 3. The amounts owed, the second largest proportionate share is, or proportion percentage that goes into making up a person's credit score, I should say, is also very, very, very key, and people don't understand it. A lot of times the consensus is, and the idea is, well, if I'm not over my limit and I make my payments on time, that's good, because the creditor's getting a lot of money in interest on their loan, so I'm a good account for that person. No, it doesn't work that way at all. If you owe from 0%, and we'll just use a $1,000 credit line, and this is a MasterCard, a Visa, any revolving type of debt, $0 to $300 on that $1,000 credit line, it scores the same as if you owe 0. Anything up to 30%. From 30 to 50%, you see about a 15-point drop in your credit score. Over 50%, 50 to 75%, you'll see a 15 to 20-point drop in your credit score. Anything over 75%, so that $1,000 credit line, if you go to $751 on that credit line, you might as well be at the limit on that credit line. That's the way the scoring works. The one other thing that I want to go back to for 1 second, credit reports are scored on the fly. A lot of times, and with you in the real estate industry, and I know with Derek, he's run up against this, and he and I have had conversations about this. You can sit down with the client, and that client can say, yeah, I'm good. I've got a great credit score. I know I'll qualify. It shouldn't be a problem at all. And you say, well, what is your average? What's your mid-FICO score? What's your middle credit score? And they'll say, I'm a 710, I'm a 720, 740. And you say, yeah, that sounds good. We shouldn't have any problem whatsoever. You go through the process, you show them a house, they submit an offer, you start doing the loan paperwork on that individual, and then at that point in time, it comes back and they're a 660, a 680. You approach your buyer and you say, well, what happened? They say, I have no idea. I'm telling you, last month, 2 weeks ago, it was 720, 740. Well, what the credit bureaus don't tell you is there's 24 different algorithms that they use to calculate credit scores. If you go into a Nordstrom's and apply for a revolving card with Nordstrom's, the scoring an algorithm that is used to calculate that score that they're going to pull is entirely different than if you go into Irvine Nissan and buy a new car. It's entirely different. The algorithms are entirely different. Well, all of the credit bureaus want you to believe that if you need to be aware of your credit scores. So as a result, go to freecreditreport.com. Go to myfreecreditreport.com. Guess who owns those companies? The credit bureaus. They own them lock, stock, and barrel. And what they do in the algorithms that they use for those credit reports and those credit scores that they send you is they back out one item out of the algorithm. And that is the risk item, the risk calculation. So what that does is they're looking at your payment history, they're looking at, they're looking at your payment history, they're looking at the amounts owed, they're looking at the length of credit, they're also looking at any new credit that you might have and types of credit, but they've taken out any risk because you're not applying what you've applied for is just a look at your score with no additional risk calculated in. You're not looking at adding a $350,000 or a $550,000 mortgage. That affects the credit score. So that's going to lower the credit score when their mortgage broker goes to pull that credit report. But the client doesn't know it, the client doesn't understand it, and furthermore, it puts you guys in the crosshairs of that client because now you have been the one delivering the bad news. You're the one delivering and telling them that no, you don't have a 740 credit score, you've got a 680 credit score, and that puts you in a whole different category. This is probably the most alarming study that has come out in the last 20 years. PIRG, Public Information Research Group, is a consumer advocacy group. They have no ties to absolutely any political organization, any bank. They are not funded. They do not take any kind of funding from any commercial enterprise whatsoever. In 2006, they came out with a report, and that report showed 29% of all credit reports contain serious errors. Now, what's determined as a serious error? Any error that has an effect of 20 points or more on a person's credit score. And believe me, there's not many where there's 20 points that moves it up. It's always low. 41% contain demographic information that was misspelled, outdated, or incorrect. Why is that important? Well, guess what? If Dana Point in one inquiry, as far as a place of residence is listed and it's spelled DNT, PNT, and the next one is spelled Dana Point, that counts as 2 residences. Anything over 3 residences starts to chip away at a person's credit score. 20% were missing major loan, mortgage, or other information to demonstrate the credit worthiness. Just simply wasn't on the person's credit report. Didn't exist. They weren't getting credit for it. Well, if you're not getting credit for it, it's almost like it's working against you. And 26 contain accounts that were closed by the customer but were incorrectly listed as closed by credit grantor. That is huge. It's a minimum of a 5-point swing. 5-point swing if you have a paid account, let's say with Sears, and that account is paid showing a 0 balance that was open for 5 years, and it says on the bottom, account closed by credit grantor, in other words, Sears said we're done, as opposed to account closed by consumer. Minimum of 5 points. Now, I don't know about you guys, but I talk with mortgage brokers, I talk with loan officers all the time. And I can't tell you just in the last 2 to 3 months how many deals have come to me because they were 2, 3, 5 points shy of hitting that milestone, that 720 or that 680 credit score that's needed for this loan program or that loan program. So 5 points, while it may not seem like a lot, believe me, it has killed more deals than you can ever imagine. The average score dropped by 16 points in 2006 to 2007. Why do I have this slide in here? Very, very simply. Prior to 2006 to 2007, the average credit score did not vary by over 1 point. Not 1 point either way. From 1974, when FICO went into existence, there was not a 1 point difference in credit score on average. In 1 year, 16-point drop in 1 year. Since that time, it's dropped, since 2007, it's dropped another 11 points. It's dropped another 11 points. Probably shouldn't surprise any of you with the economy being the way it is and the number of people that have experienced foreclosures and have experienced defaults and so forth. And one other thing that I will mention, and I'm sure a lot of you, most of you know this, but once a person's mortgage account clicks 90 days, they might as well be foreclosed upon, because by lenders they look at that as a foreclosure. Even though that foreclosure could go away, the loan could be reinstated, whatever the case may be, but it has that effect. Avoid banksters. The banks or the credit bureaus know. And the credit bureaus have an idea of what's considered a good card and what's considered a bad card. Is a First Premier credit card, which is basically this much above a secured credit card. If a First Premier credit card looked at the same way that an Amex card is looked at, or a Citibank or a Chase Platinum Visa card? Absolutely not. Absolutely not. The credit bureaus are aware of the different types of programs, the high interest rate programs, the high fee programs. Tell your clients to stay away from them. The only advantage that those cards have are for clients that have no credit, because the adage of no credit is worse than bad credit is true, especially if you're over about 27 years old. They don't buy, the credit bureaus and lenders do not buy the fact that you don't have any credit. So that actually is worse than if you have some derogatory accounts. And in those cases that you're trying to get your clients' scores up, then the First Premier cards, the cards that they could not, it's their only option, that's better than nothing. But your clients that have good credit, as well as some of these cards, some of the Capital One cards and so forth that are out there, they need to get rid of those, because those can actually be hurting their credit even if they're paid on time. Negatives, inquiries, judgments, bankruptcies, late pays, foreclosures, repossessions, and charge-offs. All of those things have obviously devastating effects on people's credit. On line item accounts, anywhere from 3, 4, 5 points on collection accounts, which isn't listed on there, but a collection account that's over 18 months old and under $1,000, it's going to be about a 5-point hit on an individual's credit. All the way up to judgments, foreclosures, which are the big ones, in bankruptcies. Bankruptcies actually can have less of an effect on a person's credit from a point scoring standpoint, and from an impact with regards to being able to borrow money, can have less of an impact than foreclosures and certain judgments. What we do, and this kind of brings into what Ascent does, but more importantly, what your clients can do, is they can go after the credit bureaus and place direct challenges. There are hold on 1 second here. There are 5 federal acts that protect your consumer. Now, a lot of those acts also protect and work on behalf of the lenders as well. But these acts, they work as a double-edged sword. And by that, I mean this. There's guidelines and regulations in each one of those acts that state what the lenders and creditors have to report and what they have to disclose to a client if something is going to be questioned. And I will tell you this, in today's world that we live in, this electronic world that Mike alluded to earlier, they don't have the ability to verify and validate it. It used to be about 10 years ago, 12 years ago, it used to be you disputed items on a credit report. You don't dispute items any longer. The last revision of the Fair Credit Reporting Act got away with disputing items. It now focuses on verification and validation of debt. And the level of that verification and validation of debt, and I'm going to bounce back, is in our case, we help clients keep the pressure on the credit reporting agencies. We force them to provide the verification and validation. Now they fight, kick, and scream because they don't want to have to go in and change their information. The reason they don't want is because they're a profit center, and that costs them money. Anytime they have to change information, that's a change in their system that they have to do midstream, and it costs them money. It costs them the bottom line. They can tell each and every one of you how much they're going to make off a credit profile within probably $100 or $200. There's a variance of that. If they see that they have to pay more than that, or they're going to have to invest more than that than they're going to make, then that's a problem. They don't want any part of it. That's when you start seeing things coming off credit reports, is when you or your client pushes to the point that they have to spend money in order to defend their position. We delete this second to the bottom, second to the last paragraph. There's no kind of adverse item that we don't see regularly removed from our client's credit report. My home run story is this: 45 days, 81 items, an increase in credit score of 210 points. It's absolutely the best results we ever got. Is that the norm? Absolutely not. My worst was 3 items, 2 remained after 13 months, and we saw a credit report that only went up about 15 points. Why did those 2 items remain? They were small mom and pop businesses, and the verification and validation, one was a jewelry company, one was a carpet cleaning, or a carpet service where they sold flooring and tile. They kept the original documentation. Who'd have thought? Who'd have thought? And so as a result, when we asked for, we got to the point of asking for that verification, they were able to provide it. Stuff doesn't come off. You can't get every item off just because you scream, yell, and complain. It has to be a reasonable and logical reason that the item comes off. Verification and validation are those reasons. And if they don't supply the verification and validation needed, the items have to be removed. We provide a complimentary review of your client's credit report. There's absolutely no cost for us to look at someone's credit report. If they got it from mycreditreport.com or myfreecreditreport.com, we'll tell them up front that the score that they're looking at is not a real score. But we can look at the items on their credit report, the accounts, and we can tell them the items that are having the greatest impact on their credit scores. And we can tell them what we would do and how long they can expect it to take for those items to come off. This is a process. It is not a transaction. It's not going to happen in 30, 60, or even 90 days. There's no way it can. The federal law, those 5 acts I told you about, the Fair Credit Reporting Act and Fair Debt Collections Practices Act, those 2 acts provide that a creditor has the first round 52 days to respond to a customer's inquiry. 52 days. Well, you can guarantee nothing's going to happen in that 52 days. And 90% of the time, they're going to require a second response or a second piece of validation. After that first round, they each have 30 days. Well, you take the 52 days and you add 30 days to that, you're at 82 days. You might as well say you're 3 months out. They're able to make an accusation against you, make it public to the world, whoever subscribes to their services, make the claims against you. You are, when you sign those little notices with every credit card and on your loan documents and so forth, you're saying they can report it. They can go ahead and report it. Whether it's accurate or not makes no difference. Now, if you catch them down the road, it makes a huge difference. But until you catch them, or until you level a complaint or levy a complaint against them, it makes no difference. They just keep reporting. The Fair Debt Collections Practices Act says that a collection company, you have to have a direct relationship in order to report to a credit bureau. If you're Bank of America and you sell a $5,000 Visa card to ABC Collections, there's no direct relationship there. Now, does ABC Collections have the right to collect? You bet they do. Do they have the right to report? No, they don't. No, they don't. And the reason they don't is because there was never a direct relationship. You never agreed to that relationship with ABC Collections. You agreed to it with Bank of America, not with ABC Collections. There's a slide in here. This I want to show. Dr. Bonnie Gooden is an advisor. She was an advisor to President George Bush. This is the first Bush. On consumer affairs. And she remarked, it's our understanding that computer models that predict credit information find that most information is more than 2 years old is non-essential. In Europe, they run credit. Experian and Equifax are both in Europe, not TransUnion. Items on people's credit reports in Europe exist for 5 years, not 7, not 10 like they do here for bankruptcies, foreclosures, and judgments. But they exist 5 years. Why is that? Because study after study after study after study shows one thing, and that is people's financial situations cycle. And they cycle about every 2 years. What's relevant today, chances are, is not going to be relevant in 2 years. So it's a moving 2-year window that they should be looking at. And that's what Dr. Gooden was referring to here. The Bureau fiercely resists the correction of the errors simply because, and I alluded to it earlier, credit bureaus, it costs them money. Credit bureaus make their money from the sale of information. The more information they have, the more value their files are. The more value their files have, the more they can charge. The more they can charge, the more profits they have. It's that simple. It's about economics. It's not about accuracy. And your clients are the ones that are paying for it. Your clients are the ones that are paying for it. We talked about this, you know, what it's costing. I've got studies in my office of what a subprime or secondary credit market individual has to pay over and above for those that have A1 credit. Now, am I standing here advocating that everybody should be able to qualify for A1 credit, be able to qualify for those, you know, 0.099% automobile loans? Absolutely not. If a person makes their bed, they have to lie in it. I agree. But just because someone hit a bump in the road doesn't mean that they have to be ruined forever. And that's what Ascent focuses on, is the fact that we help people get back going, get them back on track and re-engage them in today's credit economy. We talked about 5 years. We've kind of hit that as well. What I want to do at this point, and I've got probably less than 5 minutes right now, but if any of you have any questions, we've covered just a lot of material and a lot of information, but it's very, very important. And if any of you have any questions that I can field, I'd love to be able to at least take a stab at it.
With the lights back on?
Yeah, go ahead. Thanks, Terry. Anybody have any questions? Anybody can? Angie.
What's the best thing that we as agents can tell our clients to avoid while they're going through the process of buying a home when it comes to credit?
Sure, thanks. The best advice that you can give your agent, 2 things. Number 1, if the agent has shaky credit to start with, if credit is an issue to start with, then they need to start working on them as quickly as possible. There are certain things that people can do to almost immediately help them, that it's not going to take 60, 90, 120 days or longer. For example, a client that's got 2 or 3 credit cards that maybe is at 70% or higher on their credit cards, they pay those credit lines down. They're going to see an instant bump in their credit scores, even if they've got some negative. Because if the client's got a 640, and he's got 3 credit accounts that are charged close to their max, and he brings those down to 50%, he's going to see 30, 40-point hike in his scores the next reporting period almost instantly. The client that has good credit, that client, the best advice you can give him is don't do a thing. Don't go and apply for cars. Don't go, and that's right up to and through the day of funding of the loan. Don't do a thing.
Don't go buy the new household furniture?
Don't buy it. No. Believe it or not, about 5, 6 years ago, to emphasize this point and to illustrate this point, 5, 6 years ago, well, longer than that, because it was one of my clients. He sold the property, and he was applying through my company for a new loan. And he sold his property, he closed on the property. He had over $200,000 of cash come out of the sale of the property. Well, he made the decision that he was going to go buy a motorhome. And he had all this cash. So what he did was he went and he put $50,000 down on about a $100,000 motorhome. And he thought, well, I'm not doing anything wrong. And I gave him this advice, don't do anything. And he said, I'm not doing anything wrong, 50% down. How can I go wrong on that? No, it's not the fact that he put 50% down, it's the fact that now he has a $50,000 liability on his credit report. His credit score's pummeled. Now, they would come back in the next 90 days naturally. You make 3 payments on time on a new loan, and your credit scores are going to rebound and they're going to come right back. But he wanted to buy a house now, and he was sunk. He was dead. He was sunk and he was dead. And yes?
I just experienced kind of a situation with a client. He's a repeat client, was looking to buy a condo again. He had already talked to the mortgage person, already had good credit score. He went off, he was kind of in a situation of flux on where he was living, and he had a death in the family. He went to Mexico, came back, he decided he wanted a vacation, went to Mexico again. When I got back, he found a place he wanted to buy. We went into escrow, and I discovered that the credit report that was a little more than 60 days old had all of a sudden shot down because he had failed to pay a student loan payment of $50 a month. And it trashed his score, and it threw us out of escrow. And all because that there's probably other reasons in that factor, but the one that really instigated the whole process was the failure to pay a student loan payment.
Exactly, and the inequitable scenario that comes out of that. And the real lesson is that that client is now going to be paying the penalty for that mistake, because that's all it was. You don't go from up here to down here, barring some major financial catastrophe, just overnight. But yet, project that out 3, 6, 9 months a year, and he's still going to pay for that oversight. And that's just not right.